What's up, guys? Welcome back to DCA. So what we're going to do in this video is take a look at the difference between long-term holders, which are often regarded as smarter money, so smart money investors, versus short-term holders. We're going to see where we're at right now with relation to the long-term versus short-term holders, okay? We're also going to look at this recent capitulation event and look and see where has the capitulation come from. Has it been long-term holders? Are people that have been holding the asset for a long amount of time, are they selling the asset right now? Or was this recent capitulation from short-term holders who tend to be less experienced, more retail market investors? Because ultimately that distinction is very important. If your capitulation phase comes as a result of long-term holders, people that have been sitting on the asset for years and years, and you're seeing that they're all of a sudden dumping the asset, that's going to be very important for us to know, because that's indicating that the people that are more intimately aware of the asset, they understand the fundamentals better. They understand the fundamentals of the crypto market. And if you see them starting to capitulate, that indicates that there may be a dynamic shift in the market, that they are losing confidence in the market, or they're at least losing confidence in the ability for Bitcoin as an asset to appreciate in price in any sort of reasonable time frame. That distinction is ultimately going to be very important, and that's something we're going to need to pay attention to. But we're going to start by looking at this metric here. If we're just looking at long-term versus short-term holders, these times when we're reaching a market cycle peak, that's when you're seeing the short-term holders increase. And that's interesting because that's the time you should be getting rid of the asset, not buying the asset. But we see new retail market investors FOMOing into the market at these times. And, you can see here in 2018, they're FOMOing in right at the wrong time. Back here in 2013, they're FOMOing in right at the wrong time. And the same thing here. So the yellow is going to be the percentage of the Bitcoin supply held by short-term investors. And you can see that these short-term investors FOMO into the market at the wrong time in every single market cycle. So if we go back to 2013, you can see right here, they're FOMOing in right at the wrong time. As the yellow part of the graph increases, that means the percent of the supply held by the short-term holders is increasing. And you can see that here in 2013, here in the bear market of 2014, here in 2018, and then here in 2021, right at the peak of the market, and then into the capitulation phase of the market, retail investors are buying more and more and more of the asset, while the long-term holder supply is decreasing during those times, because those individuals, the long-term holders, are selling to the short-term holders. Okay. So this shows both short-term and long-term. But what we're going to do is narrow this in to the short-term holders. Okay, so this is the percent of the supply held by short-term holders. All right, so you can see that, at maximum, it reaches up to around 50% at very maximum. So that means the majority of the supply is going to be held by longer-term holders. And you have to remember that there are a huge number of coins held in the, anywhere from $1,000 below. So, you have something like 5 million coins just in that range. So in reality, these coins that have been sitting at $1,000 or less, you have to think that these are approaching 10 years old at this point. So many of these coins may be lost. They may be, Satoshi's coins. They may be, anything like that. A lot of people do still own the coins and they're still in possession of them, but there are likely a lot of lost coins. So in reality, when we're looking at this short-term holder percentage of the supply, it's very likely to be slightly higher than whatever we're seeing here, maybe 4 to 5% higher. So that's sort of tangential to the point. This is the more important point. We see that every single market cycle peak, and this is what I was just explaining, but we're going to really focus in on it now. Notice where the short-term holder supply is just, rapidly runs up, and it's right at the wrong time in every cycle. So you see that the short-term holder supply is increasing right as the market is about to peak. Okay. And then it rapidly decreases because they capitulate. And then here in 2014, in January of 2014, It rapidly increases right at the end of the market. It causes these massive speculative price runs. And then what happens? They keep buying into the crash because, of the common saying, buy the dip. They're thinking that they're going to come in and buy this short-term correction before the asset just goes on a massive run again. But guess what? It doesn't go on a run again. What happens is the market then crashes. Right after you see a huge run up in the short-term holder supply, you're looking at about maybe 2, maybe 3 months before the market is going to then turn over. It's not natural for a market to run up like this asset does, like this entire asset class does, and then be able to sustain that price. So what happens is you have this run up, okay? And then the long-term holders, the individuals who have been sitting on the asset for quite a while, then they start to dump the asset onto the heads of the retail market. And then you see the retail market, what do? They capitulate. They sell all of the asset. And then what happens? Once that has leveled off, once the short-term holders have essentially been wiped out of the market, usually when we get down to around this 20% range, so you can see right once we get down to around 21, 22% of the supply being held by short-term holders, what happens? That's when the market reaches its bottom and we start to turn around. So right here, we're at around 23%. Right here, we're at around 22, 23%. And you can see that in this cycle, you have to expect that as time goes on, this value will probably get a bit lower with each market cycle because more coins will be lost over time, and therefore more individuals will be considered long-term holders in spite of potentially not even having the coins anymore. So we expect that the short-term holder percentage of the supply over time will naturally get slightly lower than it was in prior market cycles. So what that's saying is, if we come to the 2018 cycle, we see the same thing. There's a rapid increase in the short-term holder supply where we go from around 25% prior to the bull run up to around 48% during the bull run. Then what happens? You can see they peak after Bitcoin peaks. The short-term holder supply peaks after Bitcoin peaks. There's just a huge sell-off. We go from 50% of the supply held by short-term holders all the way down to that, 22, 23%. And we saw the same thing in this market cycle. Starting in November, you had FOMO, November, December, January, and then basically into March. It's just clockwork. In every single cycle, you get a spike and then get dumped on by the longer term holders, and then the price crashes. And what do? They capitulate. Okay, so now you can see where are we trading at? And we are right down at this 22% level or so. Okay, so we're down here right at around 21%. All right. So this is just showing us that, the market has essentially been nearly washed out of its short-term traders. There is not a lot of retail investment in Bitcoin. And that's why people were telling you in December, January, February that they're telling you that the bull market is about to get started again. And people are showing charts, looking at TA by showing you price patterns. And we've been saying, based on the on-chain metrics that we're looking at, there is no way that we're going to go on some wild bull run that people are talking about. Where's it going to come from? You need investors. No, that's a common characteristic of every single bull run is an increase in short-term holders, because short-term holders ultimately are responsible. When you think of short-term holders, they're responsible for that wick. Okay. These aren't long-term holders doing it. They're responsible for this, 3 or 4 month move. Okay. They are responsible for this 3 or 4 month move. It's short-term holders that are running the prices up to these speculative prices. When we talk about things like, fair market or fundamental value, that is essentially not anything related to these phases of the market that I have circled here, because those phases of the market are purely speculation. Now, when we come down to lower prices and sort of level off and then start to move up again, that is a more realistic reflection of the price, a long-term price. Because what we're seeing in these short-term moves are people that have, a lot of them, no intention of being long-term investors in the asset. They just want to come in during the FOMO phase, get out, and then go on and, start investing in something else, whatever the flavor of the month is. But nonetheless, these moves that we see caused by these speculative runs in increases in short-term holders, these ultimately do bring in new long-term holders, because a lot of people will get in during these times and they'll lose money, but then they'll see, that's what I want to do. This is what I want to be a part of. This is the investment that I want to make. So then they become long-term holders. And it's why the price doesn't usually correct down to prior all-time highs or lower, because we have all of the long-term holders we already had, plus a new cohort of short-term holders then become long-term holders. Okay. Nonetheless, though, you need a reset. You have to have a reset. And that's what we had here starting in July. Essentially, the entire market got washed out. We had that small run in September, October, November, but there was no retail market backing it up. And that's why when we crashed below that 20-week, below that 50-week, and we weren't seeing any retail market coming in to sort of fuel a new rally, that's why we've been saying for so long that, it's very likely that everyone telling you that we're on our way to new all-time highs, they're ignoring, in my opinion, what is the most critical portion of what goes into a new rally, into new all-time highs. All right. And I'm not talking about going a few thousand above the prior all-time high like we did in November. I'm talking about a serious move that people were talking about, like 100K, 150K. That is going to require one of these events. It's going to require a huge influx of new short-term holders running the price up, because the institutional investors, they are not going to FOMO in. You're not going to see institutions FOMOing into the market at 100K during a rapid bull market. That's not when they will get in. They will pick their places when the price is undervalued. Okay. So they're looking at metrics like this. I assure you that institutions aren't sitting there, looking at head and shoulder patterns, for instance, and just using that to decide whether they're going to buy today or not. They may, if they're seeing a clear head and shoulder pattern, they may say, let's wait off on this. But what they're doing is they're waiting for a price target. They want a price target, and they want to see metrics that are supporting continued growth in the asset. So they look at things like, not necessarily exactly this, but they're looking at things like how many active users are there? How large is the entire crypto market getting in itself? What's the price relative to where we think this asset should be valued? Things like that. They're not sitting there looking at price patterns that people are showing you in a bear market. That's insane. Price patterns, they're so prone to failure in a bear market that they become essentially more hurtful than they are helpful. What matters in a bear market are the fundamentals of the asset. What matters in a bear market are identifying which assets are very likely to recover in the next market cycle. People looking at chart patterns right now, showing you bullish chart patterns, are simply put ignoring all of the relevant facts to what's going on in the market right now. So we're seeing that short-term holders are getting out of the asset. And what happens every time short-term holders get cleared out of the asset? Well, that marks essentially the bottom of the market cycle. So, we could see that every single time, essentially, that the retail market gets cleared out in this capitulation wick in November of 2018, they got cleared out. And what happened? That's essentially the bottom of the market cycle. Okay. Then here again, we saw in July of 2020, right after the COVID capitulation event, all of the retail market essentially got wiped out. And that led to the price going on a run again. All right. So it's when they get cleared out, that's when your institutions and your large investors and your more savvy investors, that's when they step in and they buy the asset. Because, it's a cliche saying, but be greedy when others are fearful and be fearful when others are greedy. I mean, this chart, perfectly demonstrates that for you. You could not come up with a better chart to demonstrate that exact same. It's because it's evident. It's evident when a crash is coming, and it's evident when we're approaching a point where the market is very likely to begin a new turnaround. All right. Now, it's never going to be perfect, and it's not going to be a perfect science, because ultimately, is this the point right here when we're down to 26%, or is it down here when we're down to 21%? We don't know, but that's irrelevant, because if you're dollar cost averaging into the market in January of 2015 while the price is at $360 and then it goes down to 160, well, guess what? If you can just hold off for 2 or 3 more months, then you're going to be starting on your way up from there, and you're going to be massively in profit. Okay. And the same thing goes here. It's going to ultimately be very difficult to know exactly where that bottom is. When is the peak level of capitulation? All right. But what you can see clearly is that at these certain points in the market, the retail market gets cleared out. And that is when savvy investors start acquiring. That is when we see the long-term holder supply increase rapidly with relation to the short-term holder supply. And it's exactly what we're seeing here. In this video, we covered the short-term versus the long-term holder supply. In the video we're going to do tomorrow, we're going to look at exactly where the short-term holders and the long-term holders have been selling or acquiring from. And we're going to see how this market is beginning to take shape, because there are some very clear trends forming that ultimately are going to affect the market. And that's regardless of whether we still have, a year or two of a bear market. And I'm not saying we do, but, these price dynamics that are forming in the long-term holder supply and the short-term holder supply are ultimately going to have a profound effect on the market going forward, regardless of whether the market turns around from here, or if we still have time left, time for savvy investors to continue to dollar cost average into this market, into this depressed market that, we're trading well over 50% below our all-time high now. Okay. So you can see in summary that, the price is down at $28,800. The short-term holders have been fleeing the market. We're down to approximately 21 or 22% of the entire supply is held by short-term holders. And the long-term holders, what are they doing? We showed yesterday the long-term holders are just acquiring. So that's going to be it for this one, guys. Until next time, as usual, see you.